Hey, hello everyone. Namaste. Welcome to my channel. Hope all of you are doing good. Today we are going to talk about investing in options, but in a safer way. So what is safer? So first of all, if you're trading in stocks and if you're trading in index is always safer because it's an average of all the stocks combined together. So that's the first step. So we are going to talk about trading in options in index, and we are going to talk about a strategy called hedging. How does hedging work? Hedging is basically you guarantee yourself certain amount with a certain exposure to certain range bound risk. Let's look at Nifty 50, SENSEX, Nifty Bank, Nifty IT. So all these are indexes. So the most prominent index that is looked upon is SENSEX or Nifty 50. Nifty 50 is nothing but collection of top 50 large cap companies in India or the Indian stock market. And the average, so every stock is given weightage, and the average collection of these points together forms the index, which is the Nifty 50. Now, if you look at the value the index has today, it is running around 14,823 points. Last couple of sessions, there was a rise in, or there was buying in spite of COVID. So it has seen a rise in terms of price of the index. Before we proceed, if you don't have a basic information or a basic idea of what are options, don't worry, I have already covered that. You can find the link on the top right corner. You go ahead, watch it. You will have a basic understanding of what are options and how do they work, and you can jump right back in. So options work differently for stocks and index. So when we are talking of index, within a month we have 4 expiries. And we have 3 such months. So we'll have 4 into 3, 12 expiries. Whereas in stocks, if you see, options have 3 months and there is no within a month expiry. So for example, if you buy an option for this month, which is May, the expiry is 27th of May, which is final. You have to do your transactions within this stipulated period of time. You can also choose month of June or month of July. That's up to you. So always there are 3 months available for you to trade on. So coming back to index, I mentioned you have 12 choices. So if you look within a month, there will be 4 expiry periods. So each week will have its own expiry. So for example, if you look at month of May, you will find options for week of 6th, week of 12th, and so on. So there will be 4 options to choose from. In my strategy, what I'm going to do is I'm going to invest for the full month. I am not interested in weekly expiry because the prices there are a little bit on the higher side for which I target to perform my strategy. Now for doing this, obviously you need capital. The minimum capital that is required for this is around 3.5 lakhs. How does it work? So let's assume that you feel that the market is going to grow from this index value, which is 14,800, to let's say 15,000, 15,100 and so on. You are bullish. You feel that in the coming months or the coming days, the market is going to grow. So keeping this strategy in mind or keeping this idea in mind, what you can do is you have to do 2 things. First, you have to buy a call option for 14,850, which is just 5-10 rupees above the current price, which is spot price. So basically you're buying a call on spot price and you are restricting that with a call sell on the higher side, which is let's say 15,200, because the current spot price is 14,820 something. Now we are looking at call options for 27th expiry week. So we are looking at the last day of the month. The call option for 14,850 is around 282 rupees. And if you see the Nifty 50 lot size, it is 75 quantity. So when you buy, you will have to invest 282. This is my calculator. I pulled it up. 282 into 75. So it is 21,150 rupees. So basically you'll have to put money, which is 21,150 rupees upfront. Now this is for buying a call. You bought a call. immediately what you have to do is you have to sell a call option which is in the future. So for example, a future price of 15,200. So if you look at that price, 15,200 price is going around 121 rupees. So 121 into 75, which is 9,075 rupees. Now you see there is a difference. We spent 21,000, but we got only 9,075 rupees for that. So you have to obviously match this. So in order to match this, if you do it into 2 times, it is still not matching. So you have to do it into 3 times. So for example, you have to sell 3 lots of the call option for 15,200. So hear me out. You bought a call option for 14,850 and you have sold 3 lots for call option 15,200. In this transaction, what happened? For buying a call, you do not require any margin. So it's like the exact amount that you spent, which is 21,150, right? For selling, you have to keep a margin, which is around 1 lakh or 1,20,000. So for doing 3 lots, you will have to keep 3,20,000 margin to the broker. For doing that, you will get 27,225. So you bought 1, you sold 3. For this, the net value that you got is 27,200 minus 21,150. Let's do it. So you have 6,075 rupees in hand. Now let's discuss the scenarios. Scenario 1. If the market falls. If the market falls to 14,000, no worries. You have your 6,000 rupees in hand. Whatever month. So when the month expires, and if the market is, let's say, 14,000, so Nifty 50 index value is 14,000, you will gain 7,000, you will gain 6,075 rupees, and you say, okay, fine, my luck was bad, scenario 1 happened and I got only 6,000. Fine. Scenario 2, market does not move, market remains at 14,800. No worries, again the same thing, you got 6,000 and you said, okay, market did not move. Let's consider scenario 3 where the market is moving upwards. Now this again has 2 paths, crossing 15,200 and remaining below 15,200. So let's assume it remains at 15,200 or 15,100. Let's do the calculation. This means you're gaining, because you have bought a call, anything above 14,850 is yours. So 14,850 minus 15, let's say 200, it goes up to 15,200. So what happened is you gained 350 into lot size of 75. So you gain 26,250 rupees. Let's understand scenario 3 in detail. The first path, which is it went up to 15,200 exactly. You earn 26,250 rupees. This means you earn not only the 6,000, which was previously because of this transaction, you bought 1, sold 3, you got 6,000 as a difference. Plus now you got 26,250. So in general, you got 32,000. So in 1 month, you invested around 3,50,000, which is 20,000 and the margin that you kept. So on 3,50,000, you earned 32, right? So which is around 9% if you do the calculation. Now in scenario 3, there is another thing. If it goes beyond 15,200. So for example, even if it goes beyond 15,000, if it reaches 15,300 also, still you are at break even. How? Let's do the calculation. 15,300 minus 1850, right? 1850, which is 450 points it increases, right? 450 into 75. So you gain about 33,750, but you lose 100, right? So 100 into 75 into 3 lots, because you have 3 lots. So 22,500 is your loss. because anything above 15,200 will be your loss. So 100 points above is 100 into 75, that is your one lot loss, into 3 lots, which is 22,500. But you gained how much? You gained 450 points, right? Which is 33,750. So you're still in profit of 11,250 rupees. This means you're covered up to almost 150 rupees or more than that. So if we do for 150, what is the calculation? Into 3. Yeah, exact. So 50 again. So you are still covered up to 150. This means even if the price goes to 15,350 at the month end exactly, still you are break even. So you are enjoying your 6,000 rupees in hand, and you say, okay, fine, the market went too high and I could not earn a profit. So this is a range bound hedging where you are very much secured in terms of earning returns out of it. If you see the 3 scenarios that we discussed, scenario 1, what happened? You say, okay, fine, I earned 6,000 on my 3,50,000, which is okay, 1 month, 1%, okay, fine. Scenario 2, if it does not move, if it moves only 10 points, 100 points here and there, you say, okay, fine, I earned 10,000, 5,000, whatever, or 11,000, it's okay. Scenario 3, 2 paths. First path is it reached 15,200. Then you say, excellent, that's the best case scenario for us. We earned a lot. We earned almost 9 to 10%. If it crosses that, you still are covered up to 15,350. So this means you say that, okay, my losses begin only after it reaches 15,350 onwards. So anytime you feel that you're incurring a loss, you can always square off. Now, if you look at all these 3 scenarios, obviously there is a risk of, let's say, if the market going haywire and turning up 16,000, then you have a huge loss, obviously. But what are the chances of that happening, right? And that too sustaining. So for example, the market can go up, but again it comes down. It's not that market stays at a point every day and goes up, up, up in that sense. So overall, if you see, this is a very safe kind of investment because index is always averaged out. Not all shares are going to grow. Some shares are going to go down, some shares are going to go up, sector wise, right? Some sectors like pharma or metals, which is doing great today, they're going to grow, but other sectors are not going to perform as well. The hotel industry, the aviation industry, the food industry, beverages, I don't think they're going to perform that well, right? So those are balanced out here. So that's why when you look at index, it is always balanced out. You'll never find erratic movements. Obviously you find those, but you will never find them to much extent. That is why index trading is always safer compared to stock trading, and you have better options and no hassle. Now this is just one example which I gave you. Obviously you can do it on the opposite side. So if you feel that the market is going to fall, then you can buy a put for 14,800 and you can, let's say, sell 3 puts for 14,100. Same concept like we did. If you're not comfortable with Nifty 50, you can also try your luck with Nifty Bank or let's say SENSEX. Same thing, but the same concept applies, right? Look for 1:3 generally, because this ratio will help you to minimize the margin kept, which is 3,50,000. Don't go beyond that. And it will also minimize your risk, right? So if it goes below extremities, right? If it goes below or if it goes above, you're still covered up to 100, 150 points. All right, so that was it. My 2 cents on option trading on index. So if you like the video, please hit the thumbs up. It will help grow my channel. Please do consider subscribing and leave your thoughts in the comment section. Let me know what do you think about index trading. Until next time, start early, invest now. Cheers.